Thought I'd take a look today at Centuria Office REIT. They've come out today and have seen a drop in valuations for about 70% of its portfolio. We talked about this a fair bit last week on the discounts from real estate investment trusts like Centuria Office and the market deeply discounting them ahead of these types of valuations, of revaluations downward. The dip in Centuria, largely driven by commercial real estate prices. Everyone wondering what is the right level at the moment, which has become a major concern for investors. Markets are pricing in impacts from an already slowing economy and simultaneous growth of remote working. There's the 1 year chart from Centuria Office REIT, down a bit today on this announcement, $1.38, down 20%. Nathan, what does their update tell you today?
Look, I think it's an inevitable cycle. We all knew about it, and the overall.
But we didn't know how much. Though,
yeah, exactly.
Did we?
This is the problem.
Yeah.
We still don't know,
Right.
because the cycle is only just.
So
turning.
we know clearer as
Yeah.
a result of this. You're
I
saying?
think the cycle has turned.
Right.
So we're going to get more downgrades coming.
Right.
So the market knows that property sector has been one of the underperformers. It's taken a fair hit, but I don't think the hit's finished. And the market always panics about a downgrade. And then when the downgrade comes, that doesn't mean it's a relief. There's more panic to come.
Right.
So in that context, it's been a sector that's underperformed. I don't think it's finished. I think more downside risk is coming. I mean, you just have to look at the amount of office trusts, property out there that's empty. If you wanted if you wanted office space in any major city, there's plenty of options, and people are willing to give you a lot of deals. Now, obviously, for the trust, it's a weird game because they can't actually cut the rent down, because once they cut the rent down, the valuation starts to drop.
Yep.
So they're kind of caught between a rock and a hard place. So there's a lot of empty spaces around. I think the bleeding happens for a period of time. But look, there's one thing you have to be aware of, is that if you look back at when the financial crisis hit, there's only one sector that never recovered to the pre-financial crisis level, and that's property trust.
Right.
And so these things can be substantial. So I'm not trying to pick the bottom on these things. I think there are potential mispricing in tech and retail after the beating, but the property side of things, I think, still high risk.
Okay, so the discussion last week was that the market has overdone the discounting on REITs, that there are bargains there, that the market will come back. Does this update from Centuria, does that indicate the market has overdone it or not?
Hard to tell. I think we're starting that cycle. I think the clarity will only come through after we go through the reporting season.
So there's a way to go.
I think there's a way to go.
Right.
I think you look at some of those stocks, especially in retail and so forth, we're pricing in 30, 40% downside risk.
REITs.
In the REITs, I think we just don't know. In retail, we can look at historical trends. In REITs, I think it's a lot to do with how quickly. We haven't seen this kind of cycle before.
Right.
So I think I'm not going to be judging it. I think I'm going to wait till how it plays out through the reporting season. We're a couple of months away from that, 1.5 months for that to be exact. So we'll get much more clarity. So in the meantime, I'm still keeping an eye on it. This is not a sector.
But you wouldn't get in?
Nah.
No. Daniel, what do you reckon? Has Centuria's update firmed up any beliefs that you have on whether the discounting in the REITs has been overdone or not?
Yeah, it's definitely a case-by-case type of scenario. So a case like, the COF fund, you probably have, second or third tier quality office assets and a really stretched balance sheet. So, there's a genuine reason why this has a massive discount. And like Nathan said, they don't recover because you have to consider the capital structure for REITs. So there's a lot of debt that needs to be rolled over and refinanced. Now, if they can't do that at not even just similar rates or LVRs, but even on competitive kind of terms at the moment, the equity investors will still probably get killed. So that's why it's on a massive discount. potentially other REITs, like one we own is Arena REIT. Now that has much better underlying kind of metrics where, the childcare space in terms of rents and everything is actually growing really strongly and demand really strongly. So there's opportunities, but you have to understand what's going on in the underlying. And office is probably a space we're avoiding completely at the moment. So, you have to be very, very diligent in your analysis of the balance sheet and the underlying fundamentals of the sector.
Okay, so would you be in Centuria at the moment or any of these office REITs?
No, not the pure office REITs. It's too much risk on the refinancing, and whilst there might be a high dividend potentially there's just simply too much equity risk for us.
Okay, all right. Interesting.